Hi, my name is Timothy Chu. I teach international finance in the Master of Finance program. I grew up in Hong Kong, studied in Hong Kong until Form 5, so I'm a native Hong Konger. After Form 5, after the certificate exam, I left and went to Canada to finish my last year of high school, and then obtained my undergraduate degree also in Toronto, Canada, before going to the US for my PhD degree. So what is international finance? We spend a lot of time talking about the foreign exchange market. Why do we care about this market? Well, one reason is simply it is by far the largest financial market in terms of trading volume. So we spend time talking about what kind of instruments there are in the Forex market, their risk, and the hedging of their risk. We also try to understand why different currencies would pay different interest rates. But we do not just look at the Forex market. We also look at the international equity market in the course. And we take both the perspectives of investors and corporate managers. Right? So we are probably more familiar from the investor's perspective. Right? So we can buy or sell stocks that companies issue. But we also want to think about international equities from the issuers, from the corporate manager's perspective, right? Why would they want to issue stocks and potentially have to share profits with you? So this is a bird's eye view of the course. In finance, we often talk about risk and return. Right? So how do we measure risk in finance? Right, let's say you get this question during your job interview. Right? So you are forced to answer it. How do you measure risk? Right? If you do not think about it too much, right, one may be very quick and just say, oh, risk is variance. Risk is volatility. Right? A lot of otherwise intelligent people would give that answer. But if you really think about it, right, especially in the context of all the asset pricing models that you have learned in basic finance courses, right, including the capital asset pricing model, you would then conclude that risk is for financial assets. Risk is not variance. Risk is covariance. Right? Risk is covariance. Now, this emphasis of covariance is also very prevalent in international finance. Obviously, we worry a lot about currency risk, right? But in terms of currency risk, we worry about the covariance between an exchange rate with another asset, right? It may be stocks, it may be bonds, or even real estate. Right? And to the extent that the covariance is positive or negative would have very different implications for the purposes of hedging for investors. Another place where this emphasis on covariance or covariance risk comes up is when we think about how international investors or portfolio managers should think about the risk in their portfolio. Right? Because two stocks located in the same country tend to be more highly correlated with each other than two stocks located in different countries. Right? So in general, there would be very significant benefit from diversifying your portfolio internationally. Right? So this idea of the benefits from international diversification also hinges on this idea of covariance risk. But the interesting thing or important point to realize here is not just the theory of international portfolio diversification, but also the fact that in practice, somehow people are very reluctant to actually diversify. Right? If you look at the portfolio, or if you ask your friends or even yourself, right, being a Hong Kong or Chinese investors, right, perhaps 100% or close to 100% of your portfolio are in Greater China stocks. And if you ask the same question to Japanese investors, right, maybe over 90% of their portfolio would be in Japanese stocks. And the same thing for US investors, right? They predominantly hold stocks of American companies. So the question is, why this home bias, right? Why would investors be so reluctant to hold international stocks? Is it purely because they are ignorant, that they haven't taken this international finance course? Or is there something more fundamental, something deeper? Right, so we try to go in the direction of psychology, how investor psychology may also affect their portfolio decisions.